Welcome to the debate. Today we are diving deep into the gold IRA, specifically examining the integration of physical precious metals, gold, silver, platinum, and palladium, into a tax-advantaged retirement portfolio. The central question we face is this. In our current climate of, high inflation and persistent market volatility, is a gold IRA a necessary and prudent safeguard for retirement savings? Or do these substantial costs, the inherent complexity, and frankly, the limited liquidity outweigh the potential benefits of diversification and protection? I'm firmly in the camp that the gold IRA is an absolutely essential component of modern retirement security, acting as a critical hedge against systemic dollar risk.
I come at it from a different way. While the appeal of holding, a tangible asset is certainly understandable, I'd argue for a much more cautious, balanced allocation. My focus today is really on the practical challenges, the fee structures that can, erode capital, and the high opportunity cost of locking up funds in these structures, especially for the average retiree.
Right. Let's start with the fundamental necessity, the risk offset. Traditional portfolios, those stocks and bonds we often call fiat-based investments, they're inherently linked to the health of paper currency and central bank stability. Gold IRAs provide diversification that's often negatively correlated to the dollar, protecting against high inflation and market depreciation. This isn't just some generic protection. It's a specific hedge against currency debasement, particularly critical now given the high M2 money supply growth we've seen in recent years. And fundamentally, the IRA wrapper is what makes this viable, avoiding that devastating collectibles tax, which, as you know, can be as high as 28% outside of the retirement structure.
That's a powerful argument regarding the tax efficiency. Avoiding the collectibles rate is, non-negotiable for most serious investors. But we must challenge the cost of implementation versus the perceived protection. I'm just not convinced that the cost structure is tenable for individuals who aren't rolling over large, six-figure accounts. The complexity and the substantial fees, they can quickly negate those tax benefits you mentioned. Let's look at the friction points. Setup fees, they can run up to maybe $500. Annual maintenance and storage fees typically range from $100 to $300, sometimes more. And then you have transaction fees that might swallow, say, 3% to 5% of your purchase price right off the bat. Now, for a smaller investor, maybe someone starting with, $20,000, that $300 annual fee is a guaranteed 1.5% drag on their portfolio every single year, before market performance even begins. That's capital that could be sitting in a very low-cost, maybe even zero-fee traditional ETF.
That's a fair point about the measurable fees. I concede that. But we need to look at the purpose here. We're discussing a hedge against systemic failure, not necessarily a primary growth engine. The cost you mentioned, they're arguably the price of eliminating counterparty risk. That is, the risk that the financial intermediary, like a bank or brokerage, defaults or fails. Storing your assets with approved depositories, like, say, the Delaware Depository, ensures 24/7 monitored, fully insured storage. That is a necessary expense, I'd argue, for preserving purchasing power when the traditional system might falter. You are essentially paying for tangible, isolated capital preservation.
I see the cost equation through, let's say, a different lens. While I respect the concept of an anti-systemic hedge, are we truly advising clients based on what is essentially a black swan event? What is the statistical probability that the dollar collapses in the next 10 years compared to the 100% certainty of those annual fees eating into your returns year after year? And when we see requirements like a $50,000 minimum investment from some top-tier firms like Augusta Precious Metals, for example, it immediately signals that this is a highly expensive, specialized product. The opportunity cost of having $50,000 locked up, paying fees, and potentially just tracking inflation, maybe slightly beating it, is immense compared to the potential growth in more liquid, growth-oriented assets. It just is. And moving beyond just the cost, let's talk about the severe constraints on control and liquidity. Investors are required to adhere to pretty strict IRS rules. Gold has to be 99.5% pure, silver 99.9%, and you absolutely cannot store the metals at home. This isn't just bureaucratic red tape, it severely restricts your access and control. More importantly, perhaps, we have the matter of required minimum distributions, or RMDs.
Starting at age 73 now for traditional IRAs, the government requires you to liquidate a portion of your holdings. This forces a sale regardless of whether the gold market is high or low at that moment, just so they can finally collect their deferred tax revenue. That can force an investor to liquidate a hard asset, potentially under duress, at an inopportune time.
That's an interesting point, though I would frame the regulation differently. The complexity and the standards, I don't see them merely as burdens. I see them as essential for standardization and, importantly, investor protection. The purity rules and the mandatory use of approved custodians and depositories, they ensure IRS compliance and the verifiable security of the actual metal. These rules actually prevent the investor from making really costly mistakes regarding metal eligibility, which, believe me, could lead to massive tax penalties down the road. Now, while RMDs are certainly a factor, reputable companies do mitigate the liquidity concerns somewhat by offering buyback guarantees. This provides a necessary safeguard, ensuring investors who need to sell quickly can generally do so at a fair market price, which is a key difference from having to, find a separate buyer on the open market yourself. The presence of these buyback programs, and let's face it, the varying fee structures among custodians offering options like segregated storage for extra security, although yes, it is costlier, it highlights a critical issue though. The complexity of just vetting the provider seems to be the greatest hurdle for many people. I mean, how can an investor possibly compare, say, American Hartford Gold's competitive fees against Augusta's high minimums without making those costly mistakes you hinted at earlier? This really highlights why the right answer is so personal to each retiree situation. We've seen countless people make costly mistakes. I mean, overpaying by $10,000 or sometimes even more in hidden fees, just because they followed generic advice or worse, chose a provider based on marketing hype alone. That's actually why we created a free 7-question assessment over at quiz.goldiratriplebluepoint.com. It takes about 2 minutes, honestly, and it matches your specific circumstances, your rollover amount, your timeline, your investment priorities, to the provider that actually fits your needs. Over 12,000 retirees have already used it.
Right, and I appreciate that it gives instant personalized results without the typical sales pressure. You're not stuck waiting for someone to call you back just to get the basic information you need. Understanding the nuance in company pricing, like figuring out which ones might offer free rollover services or which custodians have lower segregated storage costs, that's absolutely critical due diligence before anyone moves forward with this.
Absolutely. And that brings us back to the core structural trade-off. The tax efficiency. I'm still not convinced by the line of reasoning that the operational costs completely negate the entire tax benefit. Whether you choose a traditional IRA for those upfront tax advantages or a Roth IRA for tax-free withdrawals later, the avoidance of that punitive 28% collectibles tax rate on all the appreciation, that is a powerful long-term compounding tool. You simply cannot achieve that by holding physical gold outside an IRA. The power of the Roth structure in particular is that you can potentially liquidate a tangible asset entirely tax-free in retirement. That's huge.
Okay, while the tax benefits are certainly real, we need to examine the net effect for, let's say, the median retiree. While the growth itself might be tax-deferred or tax-free, the operational fees, those storage and custodian fees we talked about, they are generally not tax-deductible. This means those guaranteed annual fees eat directly into your capital before the tax benefits even have a chance to kick in, reducing the net overall gain. Furthermore, the IRA structure itself severely restricts access. If an individual needs emergency capital before age 59 and a half, they face a stiff 10% penalty plus ordinary income taxes on the withdrawal. This makes the asset pretty illiquid in a potential financial crisis, which, ironically, is precisely when some retirees might need access to their funds the most.
Look, despite the friction and the implementation costs we've discussed, I still maintain that a gold IRA serves as a vital anchor of diversification and a crucial hedge against systemic risk for long-term retirement planning. In a world of, let's face it, increasing geopolitical instability and looming dollar depreciation risks, the cost of secured, insured storage is simply the price you pay for preserving purchasing power over decades. The key, as we've both touched on, is strict due diligence, choosing a highly rated company known for transparency, like maybe an Augusta Precious Metals or an American Hartford Gold, to really minimize those fee drags.
My perspective remains that caution and rigorous due diligence must be the dominant factors here. This decision hinges entirely on carefully evaluating the total guaranteed annual fee structure against a retiree's existing financial bandwidth and their time horizon. The investor really has to ask themselves, is the peace of mind derived from hedging against what is statistically a low probability, high impact event worth the, say, 1% to maybe 1.5% guaranteed annual cost erosion on my portfolio? It's an investment that requires careful quantitative calculation, not just, emotional conviction based on generalized fears.
So the question for the informed investor really becomes, how do you mathematically quantify the value of that peace of mind versus the measurable erosion of returns from fees? It is, admittedly, a complex calculation.
Exactly. And whether you ultimately explore gold IRAs or not, the absolute key is making an informed decision based on your specific circumstances, not someone else's situation or some generic advice.
Thank you for joining us for the debate.